Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Right now, the most important real estate in the tech world isn't in Silicon Valley. It is actually a microscopic vertical superhighway inside a South Korean memory chip.
Yeah, that is a great way to put it.
Right, because, everyone is looking at NVIDIA and the massive software algorithms driving artificial intelligence. But today, we're doing a deep dive into the company holding the keys to NVIDIA's entire operation, and that is SK Hynix.
Exactly. And the stakes here are just, well, they're astronomical.
Specifically, we're looking at why this massive tech giant suddenly needs to raise roughly $30 billion in cash, and, why they're coming straight to Wall Street to get it.
Yeah, we are looking at a historic financial maneuver scheduled for July 10th, 2026. SK Hynix will officially list on the U.S. NASDAQ under the ticker symbol SKHY. And based on recent analysis, this is not just some, routine corporate update for a foreign company. It is a massive window into the exploding AI economy.
Oh, absolutely. Understanding how the companies making these vital memory chips actually get their funding is completely key to understanding the future of the tech market for you as an investor.
Totally.
So let's start with the sheer scale of this move. According to the data, they are aiming to raise up to 5.45 trillion won.
Which is a staggering number.
Right. And for those of us here in the U.S., that translates to about $29.4 billion. To put that into perspective, recent reporting pointed out that this capital raise is so massive, it is comparable to the legendary Saudi Aramco IPO.
It really is on that level.
And they are doing this by issuing 17.79 million American Depository Shares, or ADS. And I want to pause right here to unpack the mechanics of this, because for an everyday American investor, trying to buy stock in a South Korean company is usually a massive logistical headache.
Oh, yeah. It involves a tremendous amount of friction. If a U.S.-based pension fund or even just an individual retail investor wants to take a direct position on the KOSPI, which is the Korean exchange they have, to navigate time zone differences.
Yeah, waking up at 2 in the morning.
Exactly. And you have to open specialized foreign brokerage accounts, deal with local custodial requirements, and, constantly manage the currency exchange risk between the U.S. dollar and the Korean won.
It is exhausting just thinking about it, which is exactly why the American Depository Receipt, or ADR, structure actually exists.
Right.
I like to think of an ADR like a financial translator at the United Nations.
Yeah.
Instead of an American investor having to learn Korean, open a foreign bank account, and exchange dollars for won, a U.S. depository bank essentially steps in.
Yeah, they do the heavy lifting.
Exactly. The bank buys and holds a massive vault full of the foreign SK Hynix stock. Then the bank issues a U.S. traded certificate, the ADS, that represents a claim on those underlying shares. It basically translates the foreign stock into Wall Street language.
That is a perfect analogy. And the shares trade in U.S. dollars right here on the NASDAQ during normal U.S. market hours.
So you could just buy it in your standard brokerage account, just like you would buy stock in Apple or Ford.
Right. And the SEC filings, specifically their Form F-1, outline this exact architecture for the SK Hynix offering. By listing these American depository shares, they are drastically lowering the barrier to entry for massive pools of American capital.
It opened the floodgates.
Exactly. Global institutional investors who might have mandates that actually prevent them from buying direct foreign equity can now, seamlessly add SK Hynix to their portfolios.
But, and this is where it gets really interesting, looking closely at the data, this isn't just about taking existing shares in Korea and wrapping them in a convenient NASDAQ package.
No, it is not.
They're actually printing entirely new shares. They're expanding the total number of shares in existence to raise that $29.4 billion mountain of cash. So why do they need that much liquidity right this second?
Well, the timing is entirely driven by what analysts are calling the AI memory supercycle.
Okay, the supercycle.
Yeah. And to understand the economics of this supercycle, we really have to understand the physics of HBM, or high bandwidth memory. This specific type of memory is, quite literally, the lifeblood of modern artificial intelligence.
So let's break down the mechanics of that for the listener. Why is HBM so fundamentally different from, the standard RAM sitting inside a normal laptop or desktop computer?
It all comes down to data travel distance and latency. In a standard computer architecture, your processor and your memory chips sit flat on a motherboard, separated by a physical distance.
Like houses on a street.
Exactly. And the data has to travel back and forth across that flat plane through a limited number of connections. Now, for everyday tasks, like checking email, that is completely fine.
Right.
But training an AI model requires processing literal mountains of data simultaneously. Using standard memory for AI is like trying to shove the entire volume of the Mississippi River through a standard garden hose.
Oh, wow. Yeah, that won't work.
Right. The processor ends up starving for data because the standard memory simply cannot feed it fast enough.
So the industry had to completely rethink the physical layout of the hardware. Instead of laying chips flat next to each other, they started stacking them.
Yep. They stack them on top of each other, kind of like a high-rise building, sometimes 8 or 12 layers deep.
Okay.
But just stacking them doesn't actually solve the communication problem. The real breakthrough was a technology called TSV, or through silicon via.
Through silicon via. What does that actually mean in practice?
They literally drill microscopic holes vertically through the entire stack of silicon chips, and then they fill those holes with conductive copper. So data no longer travels across a wide, flat motherboard. It travels straight up and down.
Traversing just fractions of a millimeter.
Exactly.
So you're basically cutting that garden hose into a multi-lane vertical superhighway directly connected to the AI processor. But, I mean, drilling microscopic holes through fragile silicon and stacking them, that sounds like an absolute nightmare for heat management and manufacturing.
Oh, it is incredibly difficult. The packaging, preventing the stacked chips from just melting under the intense thermal load, maintaining high yield rates, it requires highly advanced engineering.
And this is where SK Hynix comes in, right?
Exactly. Recent analysis indicates that SK Hynix is currently leading the entire world in this specific packaging technology. They have consistently delivered the most reliable HBM chips to the market.
Which is huge.
It is. This technological edge is exactly why they beat out their massive domestic rival, Samsung, to become South Korea's most valuable company by 2026.
Wow. Beating Samsung in Korea is no small feat.
No, it is not. Companies like NVIDIA desperately need their HBM to make their AI servers function.
Okay, so that paints a very clear picture of their market dominance.
Right.
But we still need to connect that dominance to the $30 billion cash grab on the NASDAQ.
Right. And we can connect those dots by looking at corporate finance strategy. Because SK Hynix has this unassailable lead in HBM during a massive AI boom, their corporate valuation has skyrocketed.
Yeah.
The market is assigning a massive premium to their stock. Management realizes they are sitting on a sky-high paper valuation, and they are executing a textbook maneuver. They are converting that high valuation into relatively cheap growth capital.
Oh, I see. It's kind of like if the value of your house suddenly tripled because, say, a new high-speed train station opened right next door.
Yeah, exactly.
Taking out a home equity loan right now to build a state-of-the-art extension makes perfect sense.
Oh.
You are using your high on-paper valuation to buy real-world, cheap growth capital.
That is exactly what they're doing.
Meaning, because their stock price is so high, they can raise billions of dollars by giving away a much smaller percentage of the company than they would have had to give away, maybe 5 years ago.
Right. It is the most efficient possible time to raise money.
But let's look at the immediate mathematical reality of printing 17.79 million new shares. Issuing that much new stock is a massive dilution event.
It is.
And normally, markets punish that immediately because existing investors see their percentage of ownership shrink. It is like slicing a pizza into 12 pieces instead of 8. Everyone just gets less.
Yeah. Investors generally hate dilution.
But according to the research, analysts are calling this strategic dilution. So are they basically saying, yes, your slice is a smaller percentage, but we're using this $29.4 billion to build a completely new, massive pizzeria?
That is exactly the argument. You are touching on the core metric here, which is ROIC, or return on invested capital.
Right.
Investors are usually terrified of dilution. But the math entirely changes if the capital being raised is deployed into hyper-profitable assets.
Okay, break that down for me.
Sure. If the cost of giving up that equity is, say, 8%, but SK Hynix takes that cash and builds new factories that generate a 25% return, well, the absolute value of the company grows so much that everyone's smaller slice of the pie is actually worth significantly more money.
That makes a lot of sense. And the data details exactly what they are building with this $29.4 billion. This isn't going into, like, a general rainy day fund.
No, not at all.
It is tied directly to massive capital expenditure, or CapEx. We are talking about purchasing fleets of highly advanced EUV machines from ASML, and those cost hundreds of millions of dollars apiece.
They are unbelievably expensive.
Yeah, and they are developing a colossal physical footprint in South Korea, specifically the Yongin Semiconductor Cluster, alongside advanced packaging facilities in Cheongju.
And the scale of that capex is exactly how you build a moat in the semiconductor industry. Right now, global AI development is totally bottlenecked by the supply of HBM.
Whoever has the chips makes the rules.
Exactly. The company with the biggest, most advanced fabrication plants, or fabs as they are called, dictates the terms of the market. They are gearing up to mass produce the next generation of memory chips, HBM4 and HBM4E.
So they are betting that the long-term cash flows from dominating the global supply chain will completely dwarf the short-term accounting pain of diluting the shares. Okay, so they are spending $30 billion to build these massive fabs and dominate a global market. But, if they're a global heavyweight, it seems a bit absurd that their stock is still priced like a regional player.
It is a huge point of frustration for them.
Why are they being penalized by the market just for being based in Seoul? This brings us to a phenomenon the research frequently highlights, which is called the Korea discount.
Yeah, the Korea discount is a very real frustration for South Korean executives. Historically, if a Korean company makes the exact same amount of net profit as a comparable American company, the Korean company's stock is valued significantly less by the open market.
Just because of the zip code, essentially.
Basically, yeah. This discount is a mix of structural friction and capital flows. For instance, South Korea has faced persistent delays in being upgraded to the MSCI Developed Market Index.
And that index is crucial, right? Because it dictates the automatic flow of trillions of dollars of passive index funds. If you aren't on the list, a massive chunk of global capital simply isn't allowed to buy your stock.
Exactly. Furthermore, foreign institutions get spooked by strict domestic regulations. Things like sudden bans on short selling, opaque corporate governance structures typical of the family-run chaebol system, and, frankly, English-language financial disclosure delays.
Oh, I see.
Institutional investors apply a mathematical discount to the stock to compensate for all those geopolitical and regulatory headaches.
But by bypassing the domestic exchange and listing directly on the U.S. NASDAQ, SK Hynix steps right over all of that friction.
They do.
Recent analysis noted that this specific U.S. listing puts SK Hynix directly in the comparison group with U.S.-based giants like Micron. Instead of being valued against heavy industrial companies on the KOSPI, they are suddenly being valued side by side with the NVIDIA supply chain.
The valuation multiples shift entirely. U.S. investors will look at Micron's market share in HBM and then look at SK Hynix's larger market share and argue that SK Hynix deserves an equal or perhaps even higher premium evaluation.
So this NASDAQ listing is really a surgical strike designed to erase the Korea discount once and for all. But wait, hold on. Let me play devil's advocate here. We are talking about capturing a massive premium valuation just for moving to the NASDAQ. But Wall Street isn't a charity.
Definitely not.
If SK Hynix comes to the U.S., they suddenly have to open their books to the most aggressive regulatory and investor scrutiny on the planet. Are they actually ready to operate under that microscope?
That is the big question. It is a brutal trade-off, often referred to as the U.S.-style verification risk. Yes, Wall Street offers the deepest pool of liquidity in the world, but they are also the most unforgiving referees.
Right. They do not mess around.
By listing on the NASDAQ, SK Hynix subjects itself to intense quarterly forensic examinations. Wall Street analysts will tear apart their customer concentration. Currently, SK Hynix is heavily reliant on NVIDIA for its HBM revenue.
And institutional investors historically penalize companies whose fortunes are tied to a single massive client.
Exactly. If NVIDIA catches a cold, SK Hynix gets pneumonia.
And they will undoubtedly scrutinize that $29.4 billion capex burden we just talked about. Building semiconductor fabs is notorious for delays and cost overruns.
Oh, yeah. Always over budget.
If there is a single snag in the Yongin cluster construction, or if the profit margins on the new chips slip by even 0.5%, Wall Street algorithms will punish the stock instantly.
Instantly.
But beyond just financial metrics, we have to look at the geopolitical reality. Especially now, under the current Trump administration in the U.S., the regulatory landscape regarding tech exports and global supply chains is heavily scrutinized.
Geopolitics is arguably the largest external variable here. The U.S. government, utilizing entities like the Committee on Foreign Investment and strict export controls, is aggressively monitoring how advanced AI technology flows around the globe.
Especially concerning China, right?
Exactly. And SK Hynix has legacy fabrication plants located in China.
That is a complication.
A huge one. To satisfy both U.S. regulators under the Trump administration and U.S. investors, they will have to provide unprecedented transparency regarding any China-related revenue or supply chain exposure. They have to prove they are entirely compliant with U.S. national security mandates to maintain that NASDAQ premium.
So they have to navigate Wall Street's financial demands and Washington's geopolitical demands at the exact same time.
Yes, they do.
But even if they execute that perfectly, there is a fundamental risk baked into the nature of what they produce. The data points out a classic historical threat. Memory chips are an incredibly cyclical commodity.
The memory market is notoriously cyclical. It is defined by dramatic booms and devastating busts.
And right now, we are in the boom phase.
We are in the euphoria phase of the boom. AI companies are desperate, creating a severe shortage of HBM chips, which hands SK Hynix incredible pricing power. But the data shows their competitors aren't sitting still.
Right. Samsung and Micron.
Yes. They are also pouring billions of dollars into their own massive CapEx plans to catch up.
It sounds a bit like the toilet paper shortage of 2020.
That is actually a great analogy.
Right. There is a panic. Everyone builds massive new factories to pump out more product. And 2 years later, the warehouses are overflowing. It is the classic bullwhip effect in supply chains.
Exactly.
You see a massive spike in AI demand at the very end of the consumer chain. Companies like Microsoft and Google panic about missing the AI wave, so they place massive orders for servers. That demand whips backward up the supply chain, magnifying at each step until it hits the foundries.
And SK Hynix sees this unprecedented demand and overcorrects by building $30 billion worth of new factories at the very start of the chain.
Which brings us to the boomerang risk.
Yes. The massive capital expenditure takes years to build out. The fundamental danger is a timing mismatch. What happens if the AI software market matures and Microsoft and Google decide their current data centers are sufficient?
Right, if that demand slows down right as SK Hynix, Samsung, and Micron all turn the lights on at these brand new multi-billion-dollar factories in 2027 or 2028, the music just stops.
The market flips overnight from a supply bottleneck to a massive oversupply glut. Prices for memory chips plummet, profit margins evaporate, and suddenly that brilliant $29.4 billion capital raise looks like a catastrophic misallocation of resources.
Well, because they built massive capacity for a demand curve that leveled off.
Exactly.
So this move to the NASDAQ, this massive cash grab, is truly the ultimate bet. SK Hynix is betting the entire future of the company that the current AI bottleneck is a long-term structural shift in global computing architecture.
Right, and not just a cyclical software trend.
The stakes could not be higher. If their read on the market is correct, this $30 billion allows them to solidify their global dominance for a generation.
But if they are wrong, today's brilliant financial engineering becomes tomorrow's painful, margin-crushing overcapacity.
There's a lot to track here, so let's summarize the key takeaways for you, the listener, depending on your investment horizon.
Good idea.
In the short term, the data suggests preparing for extreme volatility. Watch for the arbitrage pricing gaps between the existing shares trading in Korea and the newly minted U.S. shares.
And also, be aware of potential sell-the-news behavior.
Right.
Often, once a highly anticipated listing actually occurs, early institutional investors take their profits, which can cause a temporary dip in the stock price.
So that is the short term. For the medium term, the metric to watch is institutional adoption. Pay attention to whether major AI, ETFs, and large-cap tech funds start scooping up the stock now that it is easily accessible on a U.S. exchange.
Yeah, that steady, passive buying pressure can provide a significant tailwind.
And what about the long-term perspective?
Long-term investors really need to tune out the daily noise of the NASDAQ debut and focus entirely on the ROIC execution. Keep a close eye on whether this $29.4 billion actually turns into sustained massive cash flow from those new advanced packaging facilities, or if it results in an industry-wide glut by 2028.
That really is the multi-billion-dollar question. It certainly is. And before we close out this deep dive, what is one final provocative thought you want the listener to mull over as they watch this play out?
Consider the broader implications of this maneuver. This U.S. listing by SK Hynix is an unprecedented U.S.-style re-rating experiment for a South Korean tech giant. They are attempting to completely bypass the structural weaknesses of their home market to tap directly into Wall Street's deep pockets.
Right.
If SK Hynix succeeds in this, if they achieve that premium valuation, satisfy U.S. regulators, and hold their market position, you have to ask yourself a big question.
Which is?
Which other massive international tech champions companies that are currently hiding in plain sight on local discounted exchanges around the world will be the next to make the jump to the U.S. markets?
Man, that is a fascinating dynamic to watch. If this blueprint works, we might see a flood of global heavyweights migrating their listings to New York. We will definitely be keeping a close eye on the markets on July 10th and beyond. Thank you for joining us today. Don't forget to subscribe and hit that like button.